Well, good morning. Hope you all enjoyed your morning tea. Adam, I'm not going to take offence at the comment you made before morning tea that you weren't looking forward to our session. Well, you didn't make that comment, but by implication that was there. So it's great to see everybody here. As Adam said, we're just going to actually unpack some of the things that were mentioned briefly at the outset yesterday, go into those issues a little bit deeper. The issues that we saw offshore in the banking system, how our system in Australia would be set up to respond in a similar situation, whether the current circumstances are such that there's room for us to adapt in this market. There's a lot to cover. We're going to move relatively fast. Feel free to come and talk to us. We'll see if we have time at the end to open up for questions, but please feel free to come and ask us or give us a call after the session. So we're going to start with a scene set, and I'm going to start with you, Ian. And again, at the risk of covering some of the ground mentioned yesterday, could you just give a bit more colour on what happened with SVB and First Republic over in the US in the last couple of months?
Okay, thanks, Berkeley. So we heard yesterday about how rapid interest rate rises led to a crisis for some of those mid-sized US deposit takers. And the discussion touched on the exposures of the asset side of the balance sheet to interest rate risk, and that's absolutely right. But to understand what's eventually happened, the outworkings of it, I think it's good to just follow what happens on the liability side too. So rates are rising, and these banks have a large number of depositors who've got the freedom to move their money around, to make other investments, and so they'll naturally go to places that are quicker to pass on the benefits of the rate rises, like money market mutual funds, for example, in the States. Now, if that starts to happen at the same time the market value of the assets is falling, because what the bank has done, it's invested in 30-year treasuries, not in, say, a lending book which can pass on the rate rises, then the market can perceive the bank might have a potential liquidity problem. And that then starts to lead to the withdrawals to accelerate, and then all our modern communications, our digital channels, can accelerate that practice even faster. But where's the money going? Well, the money withdrawn may well be banked in larger banks that are perceived to be stronger. And of course, what the authorities then do is tap those larger banks on the shoulder and say, can you deposit funds back in the the smaller bank that's under stress? But if that doesn't work, and it didn't work in those cases, then you need some other form of intervention. And so the FDIC uses its power to say, I think we might have an emerging systemic problem here, and therefore the cap that you normally apply to the insurance scheme for deposits in the US, they're going to raise that on an unlimited basis. But then even that hasn't either come early enough or done enough to stop the outflow. So the authorities seize the bank. And what they do, then they have to sell it. And who are they going to sell it to? Its equity is worthless. It's been funded by one or more large banks, and so the sale naturally takes place to that bank. If there's government assistance to make that sale happen, then i.e. a claim on their insurance guarantee fund, then eventually that gets recouped from the large banks through the levy that is the source of the money that goes back into that fund.
Awesome. Very well done. Thanks, Pato. So moving across to Europe and specifically Switzerland, Joe, with your deep expertise in hybrids, would you mind just taking us through what happened at Credit Suisse?
Sure. So as a lot of you may recall, over a weekend in mid-March, the Swiss regulator took action in relation to Credit Suisse, and that which had in the preceding week caused panic in global markets following queries from the SEC, so that's the US regulator, securities regulator, on its annual report. And prior to that, there had been issues reported around Credit Suisse in the preceding sort of 12 to 18 months. So after that, and then there was a refusal by Credit Suisse's largest shareholder, which was the Saudi National Bank, to invest further capital. Credit Suisse's share price took a massive hit. So the Swiss regulator intervened and did a couple of things. So the first thing was the Swiss National Bank extended an $81 billion lifeline to Credit Suisse to strengthen its liquidity and hopefully shore up investor confidence. But unfortunately, that didn't work, and markets remained extremely volatile. So over the weekend of the 18th and 19th of March. So this did happen over a weekend. I think John Lonsdale yesterday highlighted that we're probably going to need to be able to act quicker than wait for a weekend. But nevertheless, this did happen over the weekend. The Swiss regulator engineered a deal between UBS, the other very large Swiss bank, and Credit Suisse, whereby UBS agreed to buy Credit Suisse for 3.5 billion Swiss francs. Done. That's over $5 billion US dollars, just in case you don't know the exchange rate. So a statutory merger between the two parent companies of UBS and Credit Suisse is due to be effected any day now. In fact, the current press is saying it could happen on Monday. It was an unprecedented action by a regulator and was novel for a number of reasons. The two key ones being that neither bank's shareholders were required to approve the merger, and I think sort of closer to dearer to our heart because it's our practice area. One of our key practice areas was that it was an unprecedented action. It was an extraordinary direction was given by the Swiss regulator to Credit Suisse to write off all of its outstanding, what we call additional Tier 1 capital instruments. And I'll come to explain what they are just in brief. But this meant that all holders of Credit Suisse's additional Tier 1 capital instruments would not be repaid the principal invested or any further interest amounts. So quite a shocking move. And shareholders in Credit Suisse would nevertheless receive value for their shares as a result of the merger. We'll come to that as well. But as I say, just a word on terminology, and as you all know, lawyers love being clear about terminology. You'll hear us talking about AT1s. We mean capital securities that are a bit like shares and a bit like debt that sit just above shares in a bank's capital stack. So it was quite shocking for the holders of Credit Suisse's AT1s to be written off when the shareholders remained and receive value in the merger.
Well done, Joe. Thank you. And Max, these things obviously caused a lot of volatility earlier in the year. You spend a lot of time helping clients navigate financial market infrastructure. What have you seen that's also contributed to volatility that we're navigating and managing now?
Thanks, Berkeley. As a number of you in the room have seen, there have been a number of other challenging events in recent months and years. So the key events are, we saw the UK pension fund crisis, where after the ill-fated mini budget of last year, UK gilt prices plummeted, yields increased, which triggered calls on UK pension funds and required intervention by the Bank of England. We've also seen significant European and global energy price volatility across commodities markets. Of course, volatility not just in extremely high and historic prices for some commodities, but also we've seen temporary negative prices in, say, oil in the US at some stages. So genuine volatility both on the upside and the downside. We've also seen material sustained pressure of high inflation and interest rate increases, supply chain issues, the invasion of the Ukraine, not to mention COVID. Some of these, of course, are actually the root causes for the issues we've seen in the US banks and Credit Suisse. So, of course, there are a number of key differences between all of these events, the people who were affected, the root causes and reasons for the events, and who needed to step in to ensure stability in markets. But I think there are also some really important commonalities to think about for each of these events. And these are that we are in a new world of historic and sharp price changes, significant volatility, material leverage in a market of rapidly increasing rates that we haven't seen for decades, asset and liability mismatches, as we spoke about, and extreme global interconnectedness. These are creating unexpected stresses or stresses in unexpected parts of the market. And what we're seeing is that these stresses are emerging in pockets of the market where there is less resilience than was expected, and that amplifies issues across the rest of the system. So we see how increases in interest rates expose mismatches in assets and liabilities in a regional bank in the US, not a really significant bank, still a big bank, but that echoes really quickly across the Atlantic and we have the collapse and need for the regulator to step in for one of the world's largest banks in Europe. So this is all happening, as was noted yesterday morning. The speed at which these things are happening is faster than ever. And the way that banks can step in and act as stress absorbers in the way that they used to in markets has changed. And we also have a significantly greater role being performed in markets by non-bank financial institutions who have a different regulatory framework, different capital requirements, different behaviours. So as we see when depositors move out of banks into money market funds, it's very different exposures for the market generally to deal with.
Thanks, Max. And so clearly Australia's not immune from that velocity and volatility, but our banking system and the context in Australia is quite different from the US and Europe. And we heard from John Lonsdale yesterday that we have a sound, stable and resilient financial system. Banks are liquid and well-funded and credit standards are strong. I think I've got that correctly quoted. But he also said, and it's something I think we all agree with, that we can't afford to be complacent. So from a regulatory perspective, we need to look at the regulatory settings in Australia and think about whether they're fit for purpose and the current circumstances. And if they're not, work out what we should do about it from a regulatory perspective, but also from the perspective of how we govern and manage our organisations. So to that end, we want to remind everyone what should or could, based on previous experience, happen in the unlikely event that things were to unravel here in Australia, based on the regulatory settings that we have and based on the terms of the capital instruments that we have in Australia. So starting with you, Pato, you talked briefly about the FDIC. Have they got some flexibility, for instance, that we don't have or is less flexible down here?
Well, yes. The FDIC powers, of course, they have an insurance scheme, but they're actually able to use those perhaps more proactively to quell the emergence of a crisis. As I mentioned before, we have a systemic crisis, right? We're going to raise the limit. That's supposed to send a signal to calm everybody down. Now, we have a financial claims scheme here in the Banking Act. We've had it for it goes a number of years before the GFC when it was first introduced. And loosely, people call it a government guarantee of the first $250,000, right, for any protected account that you have with the bank. Of course, it's not what a lawyer would call a guarantee, and that's quite deliberate. A lawyer's guarantee, the government promises to pay, and those guarantees of that kind, they can create complacency and moral hazard. Right? And a cannier system doesn't do that. It empowers the government but doesn't oblige it. It creates backstops rather than first ports of call. And anything that one has to, in our system of government, has to respect the constitutional principle. You can't expend public funds unless you've got parliamentary approval to do so. So unless you're going to pre-fund it, right, which we don't do and we don't want to do, right, the government must have authorised the money to come out of consolidated revenue. So when you look at our financial claims scheme, yeah, it's actually triggered if the minister declares it to apply, and only after APRA has first applied for a liquidator to be put in place or a statutory manager to be put in place. And there are many, many actions that our regulators would be wanting to take in the event of a crisis affecting an institution, things which we'll touch on, like using its recovery plan, using its resolution, after that's exhausted, using its resolution plan. All of that comes into play well before you get to using our claim scheme. That's sort of a last resort. Now, for those who were around in 2008, you might also remember there was temporarily a wholesale guarantee program which was to allow banks to continue to access the capital markets on the strength of a Commonwealth guarantee. That was a real Commonwealth guarantee. It was charged for. Now that's lapsed. You could always put it back together again, I suppose, if circumstances required it. We got Parliament to authorise the guarantee in that case, and you'd have to go back there to do that if you wanted to set it up. But there has, of course, been a huge sea change in philosophy since that time in 2008. We've had all that post-GFC thinking that if a bank is not viable, and in saying that I don't mean to suggest that our banks in 2008 had actually reached that point, but the modern thinking is, well, you let something go until it becomes non-viable, and then rather than guarantee its debts, you recapitalise it by the conversion or the write-off of its capital instruments, its AT1s, the Tier 2s that Joe was mentioning. And then that's supposed to strengthen its balance sheet to enable it to continue to borrow. Now, whether that's the theory, and there's a lot of work that's gone into that lies behind that. We've never tested that in what I might call live battle conditions, but it has come up overseas, as I think we might turn to now.
Yep.
Yeah.
Thank you. Joe, you and Ian have written about what would happen under the classic bank AT1 relative to what happened to Credit Suisse. Do you want to just explain to the audience what that analysis brought out?
Yes, can do. So I guess the first thing I'd say is, we very much hope that none of our banks ever get to the point that Credit Suisse got to. But if an Australian bank did find itself in a Credit Suisse scenario, the legal position here compared with Switzerland and the terms of the Credit Suisse AT1s is a little different. So I think we can draw some comfort from that. So the key difference between the AT1 instruments of Credit Suisse and the majority of the AT1 instruments issued by Australian banks is that contractually, the Credit Suisse AT1s could be written off on a direction of the Swiss regulator. There was no doubt about that. That was in the terms, and it was clearly disclosed to the investors at the time. We've had a look at the original offer documents. Very clear that that was a possible outcome in relation to the Credit Suisse AT1s. Similarly, we have very clear disclosure around Australian AT1s when they're issued, but the key distinction is they usually provide for a conversion to ordinary shares in a similar scenario. There is a write-off backstop, so if the conversion doesn't happen when it needs to happen, then there is that backstop. But if Credit Suisse had been an Australian bank, it's likely that its AT1 instruments would have been converted into ordinary shares. So holders of those AT1s would at least have been treated equally with ordinary shareholders and receive some value in this merger that's about to take place.
Thank you. We'll move back to financial market infrastructure. And Max, a lot has happened since the GFC as well to manage counterparty credit risk. And we've started to see the implications, the flow and the ripple effect of that start to play out. And we can talk about what your recommendations are for organisations in the room, in response to how that's playing out. But can you remind everybody what has happened and just share what you're seeing in terms of those ripple effects?
Absolutely. So since the crisis, we have seen wave after wave of legislative, regulatory and prudential changes to deal with the issues that came up during the crisis to make sure we have a stronger financial system. And we do have a stronger financial system. The reforms were multifaceted. They involved dealing with governance, risk-taking, transparency, stronger capital standards, building of high-quality capital, mitigating pro-cyclicality, addressing cross-border resolutions, introducing resolution frameworks, and identifying and making sure that there's appropriate regulation for systemically important financial institutions. In the derivatives markets, we've seen an implementation of G20 commitments to provide for the clearing of OTC trades through central counterparties. We've seen the reporting of derivatives, execution requirements, and the requirement to exchange margin, high-quality collateral every day to cover derivatives exposures. These have changed our system, and we've seen them in Australia with reforms like making our banks unquestionably strong, APRA's focus on resolution planning, which has culminated in the finalisation last week of APRA's new CPS 900, which requires banks to support APRA in developing resolution plans and also regulating the management of particular risks, including interest rate risk in the banking book. And so picking up on these themes of leverage, volatility and liquidity, a key point we see is this balance and tension between counterparty credit risk and liquidity risk. Addressing counterparty credit risk, of course, is critical. We've seen this week publications by the ECB about what needs to be done to have sound management and governance practices around that. But in solving for the last crisis, we've also seen new issues emerge. In the derivatives markets, our major banks need to provide collateral every day to cover exposures under their positions. And that itself can create, and as we saw in the UK pension fund situation, that demand for collateral really puts pressure on a whole lot of the systems that the banks have to calculate what those values of collateral will be, and essentially to make sure that they have the right amount of the right type of collateral in the right place at the right time, and that is hard. And we've seen that play out for, say, the UK pension funds or others, where that just hasn't happened and it's required government intervention. So I think when we're looking at these processes, it's really important to think of what were the lessons we learned offshore, how quickly these crises emerged, how quickly they exacerbated and accelerated to others, and then what that means for you and your access to market infrastructure, the ability to properly hedge risks.
Thank you. Can I just test, Adam, the shot clock says 1.5. Is that right, or have we got another 10?
1.5 than 10.
Did you do that?
Closer to 1.5.
Okay, thank you. Okay, so I might just summarise the other things that we've seen play out that were again touched upon yesterday is the velocity of information, creating this speed of information, sometimes disinformation, which is leading to certain results. We've seen the velocity of capital being able to be withdrawal from financial institutions. We've seen the interest rate rise much more rapid than in the previous in the G. 5, thank you. So I can talk a bit slower.
This is volatility of markets, and we can see sort of prices adjusting.
And obviously cyber risk. So there's a lot more at play. So we're just now going to unpack regulatory settings and whether there's room to adapt, I think, is the phrase we would use from a regulatory perspective, but also from a governance and management perspective. Joe, on the hybrid side, we've got a lot of comfort from what you've said. Is there anything more we could or should be doing there?
Yeah, so look, there isn't much we can do on the terms, so that the contract that sits behind these instruments, because they contain terms that are required to be there for APRA prudential purposes. However, I think what the Credit Suisse write-off has shown us is that investors in those securities didn't expect the write-off. So sure, they read the disclosure. Disclosure was very clear. They did not expect to be written off. They certainly did not expect to find themselves, I guess, in a worse position to the shareholders. So I think what we need to do is really just make sure investors do understand that. They need to understand what are the consequences of holding these securities. There is a risk that they will be converted into shares or written off at the behest of the regulator. Yeah, I think that's the key thing we can do.
Great advice. Max, derivatives markets, what are you recommending to your clients?
I think the key word that struck me from Dr. Chalmers' speech yesterday morning was vigilance. We're clearly in a risk-on environment, and so it is really important to be vigilant about your risks, your exposures, your counterparties, the impact of volatility and changes in prices, your liquidity and collateral needs, and your trading terms. And that flows into the models and methodologies that are used. And we'll really see that, I think, tested by APRA in the resolution planning process. It's really important to not only hope that it is okay on the day, but to have planned beforehand and developed default playbooks, set out robust internal management and governance regimes to make sure you get the right people in the room to make the really hard decisions about default, whether it's your own default or your counterparty's default. And I think I might actually finish my comments by quoting not the great Adam Smith, but the great Adam Spencer in his comments yesterday of, really, it's all about managing risk.
Thank you, Max. Pato, you spent a lot of time talking to various stakeholders. What are you suggesting people think about, including regulators, in terms of how we might be able to adapt?
Well, I think as was said yesterday, it's the speed of crises in the digital environment is the single most novel determinative factor that everyone has to respond to. And Max has touched on some of the things that industry needs to think about. Governments, well, you'll always ask, have we got the toolkit complete, right? Do we have adequate regulatory cooperation? Take a little example. In 2008, one of the most useful things done was to institute a temporary short selling ban on securities and financial institutions, right? Okay, that's ASIC has to do that, so APRA and ASIC need to talk, as they do. So our system's good like that. What's the really big point, I think, at the moment? It's always, when judging the point of intervention, when is that appropriate as a firm starts to fail? Now, the principle's clear, it's non-viability. Applying that is always difficult. Do you just leave it like that? Are you better off if you're more transparent about the indicia that are used to assess that? And how does that increasing speed of deterioration influence that judgment? Now, everyone wants to stop the raft going over Niagara Falls. The currents are running faster than they used to. Yesterday we heard the weekend is too long a period of time. But if that leads you to, or leads regulators to say, I want to intervene too early, well, as the Credit Suisse case shows, you can produce some pretty arbitrary outcomes, which some people would say are unfair. And outcomes that are unfair in the long term, they're not good because they actually undermine confidence in markets. So then, turning to markets, the management of the crisis is all about assessing likely market behaviour. Market participants, they bet on behaviour in an environment where people, issuers, but especially regulators, they have powers but they don't have commitments. And the calculus of that bet depends on factors such, do I think the bank is resolvable without government support? It's a great play to buy securities at a distressed price if I think the government's going to step in and actually bail me out. But it's not if I'm going to end up holding the losses. Connected with that, in making that assessment, you have to ask, so who holds the capital? Who's buying it up? Is it in domestic or retail hands? Is it in wholesale hands? Now, that's a policy choice as to where that should be, or is that a policy choice that we've actually made, or is that an accidental outworking of our tax laws? I'm not going to attempt to answer anything like that, but Australia Inc., in terms of working out how it funds itself, could ask itself what makes for a better system. And industry can ask itself, are there better corporate structures than we currently have? I think holding companies have a place to play in this environment, though that's not the reason why people have been looking at them of late. So issues for industry, but yeah, also issues for government, but it comes back to that assessment of how markets behave in practice.
Brilliant. Thank you very much. I think our time is up, but thank you all for your attention. I hope you found that useful. Thank you to my colleagues for their brilliant insights. Well done to the ABA for putting on such a thoughtful conference. Appreciate the opportunity to speak to you all. Obviously value the relationships we have with many people in this audience. So thanks very much.
And thank you, Berkeley. Thanks, mate.